here, and I'm just loading up. Okay, excellent. So I just want to verify that you can hear me at this point. Okay. Dwayne, could you hear me at this point?
Yeah, we hear you fine, Efrem. I see your screen as well.
Okay, excellent. So we're here today really to discuss the state of the American and global economy and the impact that it's going to have on the financial markets. There has been a tremendous amount of volatility of late that has developed since the end of March specifically and has been escalating ever since the first week of May, and really starting to get darn right frightening to some sectors and some individuals as the market is proceeding into this evening hour. One of the main pieces of information you should take home is the fact that it's not just the equity markets that are in a mess right now. It's also a distortion in the way financial instruments are being traded in anticipation that the governments around the world are going to be doing something to get us out of this turmoil. Now, really, if we scroll back, a few years here where the real big crisis began in 2007, the intelligence at that time indicated that there was a crisis on the horizon about 3 months prior to that. The area right over here was the area where we kind of identified problems developing, and then it eventually resulted in a very large move down to near 650 area on the S&P. Now, the thing is, ever since March of 2009, when there was a mass increase in the money supply and money printing by the Federal Reserve and different economies around the world to get us out of the troubles, what it actually created was a situation far more precarious than we had back in 2008. And what I mean by that is that it's not just the equity markets that are extremely overvalued right now, but it's also the fact that there really weren't that many avenues, especially in the months between the beginning of the year and especially going into this consolidation that we had between March and April. And what happened in that period is that a lot of retail investors as well as major hedge funds were piling into positions into the corporate bond market, high-grade yield, as well as high-grade dividend-paying equities, because there's really no yield anymore when you're actually looking at government-guaranteed securities, considering that they drove them down to such low levels in order to create a situation that made it appear that things were actually improving in the equity markets. But all that's really happened is that money has been sloshing around into different sectors, such as technology and energy, and it really drove prices high. So in one sense, while they were trying to help the situation, what they really did is they cornered the market and made it more expensive for the average individual to actually survive in this kind of economy, especially considering that the unemployment rate has been at exceptionally higher levels than it has been in the past, and holding, with unemployment levels at such a rate above 8% to perhaps as high as 10%. That's obviously not good considering the deteriorating fundamentals. Also, all the money that went into the corporate bond market thinking that everything is going to be safe is not necessarily the case, because we're making the assumption that in the best of times with all this money printing, that companies, when their debts become due, are they going to be able to pay off their debts if there's even a small change in interest rates? And many have already suggested that even slight changes in interest rates, whether in the intermediate curve, especially like the 5-year, which would impact the banks on their term deposits, and the 10-year that would impact homeowners, it would certainly be an issue and escalate the foreclosures of those markets and really impact the bottom line of banking institutions if there is a change. And what I'm seeing right now on the horizon, just like I saw in 2007, and just like I actually indicated in prior Twitter feed tweets, as well as in prior video alerts on our website, nakedswantrading.com, I was indicating that in the March period, just as Apple was approaching its all-time high into the $630 to $642 area. And what I did say at that time is that Apple would be the canary in the coal mine that would actually indicate a reversal in the rest of the market. Because what's been happening in each crisis, ever really since the 1998 crisis, that every time the market suffered a pullback, the next time it rallied up to a new high, there were fewer and fewer big-name securities that actually participated in that rally. And eventually, we got to the point, going into the end of March this year, where it was really two different asset classes. You had Apple and then the rest of the world. And you can't have one stock that, that people like to represent the entire market. And when Apple gave way, and it gave way after our market call that was put out that when Apple breaks below $633, that was put out on March 30th, that there would be a rapid escalation downward and go into the low 500s and then much lower as the market starts breaking apart. And that's exactly what's happened. And it wasn't just Apple, but there were numerous other securities in the NASDAQ market, as well as big cap names in the Dow Jones market at the time that were making peaks. And right now, the chart that you're seeing on the screen is a picture of the S&P 500 as of today. And the screen is a little bit complex because it's not your normal kind of chart. In usual charts, you basically have any indicators of expectations of the future ending at the current bar. So basically what you're seeing on the screen is these rectangular black and navy bars, okay, represent the range of price within a given day's time. And you can see today's range has really expanded, with today's high being up at 1330.75 on the S&P 500 June futures, and the low being at 1300.50 as of 4:15 p.m. Okay, and what you're seeing here is that you're seeing a whole bunch of boundaries into the future that actually represent human market perceptions. The thing is that traders in the market, and whether they're short-term traders that look out a few days or a few seconds like algo bots, or long-term generational traders like the Warren Buffett style that will hold positions for 20 to 30 years, you can't really just focus on one group of investors and expect to understand how the market is going to actually react to the way they put positions on. To really understand the dynamics around how they react, what I've designed over a 16-year period is this new science of market trading called bottom-down intelligence. And what that allows us to do, it allows us to look at all the different trader groups and see how they interact in a social setting around their expectations of changes in price and momentum. Now, the only scientific variable that people were able to use up until now has really been statistical analysis, going back to the past, trying to identify patterns to see if those patterns are likely to continue in the future. And what more than not, what people will find is that no matter how far back you go and how much research you do, patterns never replicate in the same sequence, even if they seem to overlap exactly. And the reason why is because the institutions of capital, the trader types, the types of technology, as well as the size of the data sets expand over time, and it allows for more ways for traders on different time horizons and different timelines to actually analyze information. So what I've done here is I try to create a dynamic evolutionary system that evolves with the market so that it actually will explain how people interact at different scales and result in a movement that provides large-scale moves that cannot be explained by past statistical precedent. And that's the key difference between bottom-down intelligence and pattern recognition that most all other systems use today. And I don't want to go any further into the extreme details of the mechanics, but there is currently an article that has been published in Traders World magazine, 51st issue, and you could basically go over to our website within the next 3 or 4 days, and we'll actually have that article put onto our website. Otherwise, it's only accessible to people that have subscribed to Traders World magazine. And also, in the coming days and weeks, I'm going to be putting out some more detailed white papers and videos that actually explain the intrinsics of the trading strategy and how it could be useful to short-term traders, intermediate-term traders, as well as hedge fund managers or policymakers alike. Now, without further ado, I'd like to now talk about what is going to happen given the way the market is closed so far going into Thursday. And usually mutual fund managers and hedge fund managers, make a lot of critical decisions at the end of the week, and also considering option expiration period. There's going to be a lot of interesting things going on. So what should we be looking forward to? Well, I'm not so sure that we should be looking forward to too much good, but here's the range of things that are likely to take place. Now, what's going to end up happening is the S&P 500, even if there are rallies that take place, regardless of how good news is, it is extremely, extremely unlikely that you will see any rallies that go outside of this purple boundary. So this purple boundary, as of today, starts off at 1348, and you only really have to go back 1, 2, 3, 4 days, or even 3 days, where we were at that purple boundary, and you saw what happened. As soon as we broke it, any spikes into it acted as resistance. And if I zoom in, you can see over here, here's the purple boundary, we got underneath it, and now it acted as resistance. It's not going to be able to get above this purple boundary. And that purple boundary, even as you go into the midsummer, only goes as high as 1369.50. And when you think about it, if you go back to the last time the market was actually at 1369.50, that was actually on May the 4th, which is 2 days after we issued an alert on naked swan trading that indicated that don't be fooled by that intraday rally that took place between April 23rd and May the 1st. We actually indicated that several days in advance of there that the market would roll over on that date. And now what we're indicating on our post and indicating today live is that this market is bounded over here. So anytime it goes there, it's a great trading opportunity. So really pretty much any trading system that sells in that area could make, could do better than if they weren't in this trading environment. But at the same time, I'd like just to mention for securities regulation purposes that this is an informational and research purpose session only, and this is not intended to indicate advisory or what trade should be taken. Trading is risky as indicated in our disclaimer in the beginning. But based on what this analytic and bottom-down intelligence approach is indicating is that, okay, so far we indicated what the resistance levels are, overhead resistance, but where is this thing going? What you could see over here, and what you should focus on are the lower boundaries. Now, when we get underneath the lower boundary, and there's a big gap to the next boundary, that represents how volatility is going to be expanding into the future, okay? So because the future hasn't yet arrived, but we could actually see what the momentum indicators of traders will look like on different timescales before information even prints. So it's almost like reverse engineering their momentum indicators and then overlapping what every momentum indicator will look like at future points in time so that we could actually get ahead of the market and see and anticipate how people will react to information. So this is more like, instead of trying to analyze changes in price, we're trying to really analyze how resilient the market will be to good news or bad news. And in this case, because the market is rolling over from a high position, then really any positive news that comes into the market is going to be the fuel that will set the stage for the next leg down. Now currently, we're in free fall right now. So really there is no even short-term real support until 1285, okay? But it's not real support, because in this system, whenever you see a line starting to curve upward, it actually means that if you get underneath that line, it means that the perceptions of traders in the future beyond that line are becoming more bearish. Why? Because each one of these lines represent zero momentum. Okay, that means that people, so if you were to throw a ball up in the air, just before it comes down back to Earth at a very fast rate, its acceleration goes to zero. It's the same idea with this line. You could think of it this way, that when price lands on any one of these lines, now there's no difference between one line and another. It's just that the lines that go further into the future represent traders who have longer time horizons, and the lines that are shorter represent shorter-term traders like day traders or position traders. Now, the thing is that if this represents zero, that means that any time price gets underneath here, it's below zero. And that means that any rational investor on that time scale is going to perceive negative momentum and will act in a bearish way and sell the market. Now, the thing is, because these boundaries extend into the future and are calibrated to future levels of what zero momentum are for those traders, it's actually telling us when the ball that's thrown up into the air is going to come landing back down to Earth. Now, Earth in this system is the next boundary down. So when you're looking over here, as big as this drop has been in the near term, the next drop, the next time we actually get underneath the critical area on the S&P, 1283.50, we get underneath 1283.50 and especially stay there, completely trade underneath there for 1 day. And that's not even a question. We are going to be doing that, but I'm just saying when it happens, here's what you should expect in earnest. You should expect a rapid acceleration, okay, down towards this teal boundary. And the most extreme level of that boundary is around 1162 on the S&P 500 futures. Now, as of today, the S&P 500 cash market that most people see on television currently is at around 1304.86. So there's not much of a difference. Usually when the futures roll to the next contract month, which will happen in the beginning of June, then September futures will trade, and there'll usually be like a 5 to 8 point spread between the cash market and the futures. I'm just mentioning that for individuals that happen to be on right now that don't trade the futures. You should just expect the numbers that I'm giving to you should be within a 5 to 10 point spread. And that's not a big deal when you're talking about moves that are over 100 points lower on the indices. Okay, and now yeah, so that's quite a large price spread. So that you would expect that the volatility on options within the S&P 500 should expand significantly. But I'd like to touch on something very, very interesting. A while back, and actually leading up to this big rally into the March period, there were many commentators on television discussing the fact that why isn't the VIX index responding like it used to? Like a long time ago, if there were even some sharp sell-offs on some days, you would get a spike in the VIX. And what's basically been happening to the exchange-traded fund, which correlates to the VIX, which is the VXX short-term exchange-traded short-term VIX index, basically, that ETF, along with the VIX itself, which trades on the SIBO, basically has not been spiking upward. And usually when fear creeps into the market, it rallies. So, and what I'm suggesting is the fact that there's some complex hedging strategies that have been taking place in this market as the market's been percolating up due to a lot of the hot money that's come into the market due to the exceptionally low interest rates. And because of that, spread trading could actually distort some of the values of the VIX. The other thing to know is that the VIX index is really based on implied volatility of options, and that represents people's expectation that there's going to be really some strong negative sentiment in the future. And what is opening up an arbitrage opportunity for short sellers right now is the fact that individuals that have been betting that there's not going to be much volatility are proven to be wrong right now. And part of the reason is, if they've been thinking that, well, if the Fed got us out of the last thing, they'll just keep on pumping money and it won't be an issue. But like I said, we're at a critical point right now where oil rallied up over $100 as we got this rally to the highs. So it kind of works against the whole purpose of pumping the money in. If these other things are going to impact the economy and then drag down certain industries and slow them down, it actually eventually at a certain level, when commodities get to a certain level, it has a negative impact and a positive feedback effect in driving prices lower once the train starts moving, and it certainly has started moving since the beginning of May. So my real concern here, and like it has been in 2008, and like my analyses that I've done, and I've gone back to studying ancient data even, back to the 1600s and even in the grain markets going way back, further than that. And in all those situations, the same kind of signature of these forward momentum lines exist. And it really doesn't matter what security you look at. When this signature is there, it's indicating that there's going to be an escalation either upward or downward in price. And in this case, downward in price. So the real danger in this market comes, obviously we get that first flush in Q2, and but the real danger is that all sectors, okay, let's imagine now we get a rally after we come down to this area, okay? We get a rally. Well, that rally is going to be contained by this yellow line. So even after a big flash crash in the market, the rallies, yes, you could get a rally back to 1232. You could even get a rally into the second or third quarter as high as 1323 in here, okay? But if this fails and turns around, and even if it doesn't fail, it's going to fail at the 1365 area, then basically at that point, and what's going to end up happening is all sectors in the S&P 500, and I analyzed those 10 sectors, and so far it's only been a few sectors that have really caused this tanking in the market. But in the second part of the, well, in the third or fourth quarter, you're going to get a situation after this initial move down that will then accelerate it at a much faster pace. And that could start as early as September the 23rd or as late as December the 7th to the 15th. And once that starts, the next leg down is going to be 1076. And then underneath that, we're talking below 800 on the S&P as we go into May of next year. So it's a very bleak picture. The only good thing is that for traders that are actively trading the market, there'll be such exceptional volatility that you could actually make an exceptional amount of money trading a lot of the big spikes. But it's very important also to have the risk management in place, and that's the whole idea of what we do at Naked Swan Trading here. And the idea is to construct a risk map that identifies the points in the future where traders are going to attack the market. And that's precisely what's happening with the S&P. Now what I'd like to do is take you to a chart that is quite interesting. And it's a chart of this index called the Dorchester Index. It's actually used by the Federal Reserve. It's a proprietary index, and it's the broadest representation of equities in the U.S. market. So it even covers way more than the Wilshire 5000. Is there a question?
Yeah, Efrem, I'd like to just interject here. We have a couple questions, and I forgot to tell you to undock that question link there if you can, and you can, I don't know if you're seeing those or not. Vincent asked a question, is now a good time to buy gold? He says he times off a low of 1550 with a bit of a bump today. And Jay Lim has a question, but doesn't the purple line also tend to converge, that is, move down to meet S&P 500? So those are the two questions. The rest of you who have not typed any questions, this is interactive, so feel free to ask questions, type them in, and we'll address them as we move along. Okay, Efrem, back to you.
Sure. Okay, I'll start with the gold market. Basically, in gold right now, gold's been coming down for a couple of reasons. Number one, when you get a crisis in the market, usually at some point gold behaves well, but because gold also is impacted by the U.S. dollar rising, and a rising value of the U.S. dollar, since gold is priced in U.S. dollars, impacts it in a negative way. And there's a lot of currency volatility taking place today, and especially when it comes to what it has to say about commodities. And that's something I'll be touching on after I talk about the gold chart. But the Australian dollar, U.S. dollar cross rate, it appears as if the Australian dollar is going to crash. And that was indicated before it started accelerating below parity. And it's going to crash relative to the U.S. dollar for a 20% drop in a very, over a relatively brief period of time, and stay down and stay very, very weak. And since Australia is a very commodity-centric country, so is Canada, but it's going to be impacted a lot more just because where they are in their in the weakness in their economy relative to Canada, a lot more weaker, so they're going to have to drive interest rates downward, and that's going to actually not attract as much capital into their accounts. Okay, but on top of that, it's also because of lowering demand for a number of commodities due to the anticipated slowdown, and that's where a lot of the smart money knows about it first. Okay, now back to gold. Looking at gold over here, it's not like, I would not expect until we get a good flush of this crisis over, I wouldn't get too excited about gold other than just short-term trading opportunities. If you notice all these little boundaries here that are sloped up, okay, basically that means that traders on small time horizons or small timelines are actually interpreting the market as being more bearish as we go into this period, okay? But that only represents those smaller term traders. Of course, you've got to look at the entire market. But as long as you've got short-term traders putting pressure on the market, you're going to be, the key thing is until price gets above 17.1250 on the gold market, there's really no interest. And it's not like we have to wait for it to go to 17.1250. It's just that you just want it's just that it's not the same kind of situation that we have, for example, in the S&P. In the S&P, it's a very, very clear signal that the market wants to go down. In the gold market, it's not a setup right now where gold just wants to explode and never look back, okay? That doesn't mean that for bottom pickers, this doesn't work out, okay? But I would still anticipate that this will be retested, and you go back to 1517, okay? But we are getting underneath this black boundary over here, okay? And until we really even, like right now, until we even, I wouldn't even think about anything bullish in gold until at least after May the 30th, okay? And there's a lot of situations happening in the market as we go into between the 23rd and June the 7th. That's where you could get a capitulation in the market. We'll have to see. And the first indication of that would be how the U.S. bond market responds at that point. And if you see a breakdown in bonds, then maybe at that point that would indicate that you could actually get a setup that could actually take gold back up. But I mean, at least you'd have to get above 1627.50, and that would have to be after the end of May. And considering that this little rally we had right now is almost halfway back to that point, for somebody just thinking on going long as a long-term trader, it's just unnecessary in the context of how I look at things, because the way things set up, if there's going to be a major signal for gold, this thing would set up in a certain way and you'd be able to get in for a move where, and I believe the next move in gold when it does happen will be around 2,300 on gold, but it's just not right now. And the danger here for somebody who's too bullish on gold, that doesn't wait for any kind of, for it to first go back up to this level. What I anticipate is it would have to first go up to this level and then come down and test this level, form a consolidation, and then break out sometime in June. And if it does that, you're still, as far as I'm concerned, limited, in that 1770 to 1793 area, because you're getting these boundaries starting to slope up, and they're acting as resistance. So to really get a bull market that's ready for gold to go, you're going to need all these boundaries slope down, and that ain't going to happen at least until the third quarter. And the problem is that if somebody is rushing into this market too soon to buy it as a long-term investment, thinking that it can't go lower, here's the big problem, that if this starts accelerating down and retesting this point and then gets underneath this yellow line, there's a huge gap between that yellow line and 1,300, okay? And basically, yes, I mean, 1574 to 1,300, that's kind of like a $15 stock going to 13. Maybe not a big deal for a long-term investor that believes gold's going over 2,300 and it's going back to 23. That's true, but I still believe that there'll be plenty of time, and we will put alerts out when that time is prime. For that kind of investor. As a short-term trader, yes, there'll be buy signals on 5-minute charts, 30-minute charts every day going in these oscillating zones, but there's just a lot of risk there. And also another thing to take into account is that the type of selling action that I expect to take place is going to be very similar to the kind of action that we saw in 2008. And if you go back to 2008, you could see that gold did not behave very well at all. It actually came down very strongly from the highs, okay? And I'm not saying that it's going to replicate that structure, but what I am saying is that when you have so many industry groups starting to break down, and I've got numerous ones in very large cap Dow equities where a lot of people are, in that, and once the pain is felt, a lot of people are going to try to sell liquid securities, okay? And gold is quite a liquid market for people to trade. So that so what could end up happening is that people could just sell an asset class that inherently would normally be a safe haven just to actually raise cash to cover margin debt and all kinds of situations that arise when liquidity breaks down in the market. And I do believe that we're going to have a liquidity event that's likely to take place in two parts. Part number one, which will be, still a very large scale, continuing into the early June period at least, possibly mid-July. And then the next one, which will be likely equal or bigger than 2008, which will start either the third or fourth quarter and continue through May of next year or beyond. And during those episodes, you really want not to be catching falling knives in gold. You want to be having real buy signals that are setting up with confirmation, and there certainly isn't that. Not in my system, and not really for anything that is, any kind of strategic strategy that would actually indicate that there is a tremendous buying potential in gold. Now, yes, what I do see is that if we do get down to the 1,300 area, then likely these boundaries will start sloping up, and eventually you will get a consolidation. And the next time we do break out, I would say, above 1650, and let's say that happens, at some point next year or this fall, then yes, at that point you could get an initial spike up to 1850, and then once you clear 1898, sky's the limit. But that isn't today. So that's the view on gold. Also, right now, I'm just going to go back to the S&P chart and answer that question regarding the purple boundary. Okay, so I'm going to zoom in over here. Okay, so basically what I was saying is that if we clear this purple boundary, and especially clearing that boundary, you know, after, say, June 1st especially, then, and the reason why I say that is because this red boundary starts inflecting and sloping up, and that becomes a longer-term boundary that is going to become bearish for the market. So now we have a whole bunch of boundaries that are actually engaging in selling. Now, yes, it's true that this purple boundary rises and then turns down in the future. Okay, so you know well, actually, this is the first target boundary. We were talking about this purple boundary over here. Yes, it eventually does turn down. Okay, but what's going to get us out of this market in terms of a trailing stop that's going to indicate that the selling pressure is over for this you know, on this magnitude is basically going to be this. Okay, I'm going to zoom in over here. This purple boundary that you see over here is actually the long-term stop for the market. But the thing is, it's not a stop. Well, this thing is sloped up. It actually means that selling pressure is going to be continuing down. So I wouldn't get caught up in what the meanings of this is. This will all be explained in a future video. But what you should understand is that what will happen as prices move down is that this boundary will eventually come down and meet price. And what will happen is price will then rally into that boundary off of a much lower level and cause that boundary to turn up again. And at that point, we're going to get the next selling wave. And then eventually that purple boundary will start coming down and trail price. And eventually when we get on the other side of that boundary, which will be, you know, if it happens over here or if it happens next year when we get, you know, down to 800, then that's the indicator that the selling is done. But we haven't even, first of all, this purple boundary hasn't even come down to meet price. It's actually, the acceleration in price down is actually causing the perceptions of traders on this purple time horizon to actually become more bearish even as we progress further into the year, which basically means that we shouldn't even be thinking about buying expectations. We should be thinking about a severe risk of a market meltdown. And I hope that answers your question. Dwayne, any indications that answers the question there?
Yeah, I think you have a lot to cover, Efrem, and you were getting ready to go into something else that you were pretty excited about. So as you type in your questions, go ahead and do so, and we'll come back to them at the end, make sure we cover all of them. But okay. Also want to make sure you cover what you have on your agenda today as well.
Yes, absolutely. Okay, so right now, what I talked about earlier was the Dorchester Index representing 80% of the market, even a larger part of the market than the Wilshire 5000. And, you know, people get caught up looking at just the Dow or the 500 stocks in the S&P, and people think it's a lot of stocks. But the reality is the average investor doesn't own most of those stocks. The average investor owns a lot of the mid-cap stocks that aren't even in those indices. And, you know, if events look rosy in one index, it doesn't mean that people aren't being affected in a huge way. Like lately, there's a lot of stocks that have been gapping down 30% just on earnings, and nobody really talks about them. And, you know, we do mention them at Naked Swan Trader, and I've actually identified a number of those back in March that we're going to roll over, and they did, and you could just view that at the website. But right now, I'm going to take us to the Dorchester Index. On TradeStation, the actual symbol is $CPM KTS .X. Excuse me. It's KTS without. Okay, wait 1 second here. I just have to type it in again. Okay, there it is. So it's without the .X. It's $CPM KTS. Okay, it's called the Capital Markets Index, And basically, it is telling a very ominous picture about the market, even more so than the S&P. And this is really the one to go by. Do you see the difference? Remember in the S&P, we didn't even get underneath one of these inflection points. We're right past the inflection point of this red boundary. Everything is curled up, high energy packed in here. And what it's showing us is that when we have a situation when one of these upper boundaries starts curling underneath a longer term boundary, and I mean the longer term because you can see here this black boundary extends further into the future. Okay, so this may represent like traders, trading in a multi-year basis. This will be traders on a shorter time frame. You could see here that this navy boundary curls underneath and they're sloped up into the future. And when you get a price that gets underneath that boundary, what it tells me is that prices are going to be coming down to the bottom of the black boundary. Now the question is, and this is what a lot of people ask, is that, well, if this boundary is sloped up in the future, like what would happen if this boundary was sloped up at 45 degrees? And the question is, well, if it meets the boundary, there's two ways it can meet it. Price goes nowhere sideways and eventually hits it, and that's no good for a short trader that's trying to make money. Or does it just go down to this level, or does it go down to this level? Where it goes down is it goes down to the point where the inflection point of that shorter boundary is. So it would come down at least to the value of 11,730. Why is that a big deal? Well, it's currently at 13,600. But the big deal is this, that if you go back in time, I'm going to put a horizontal line on the screen right now, okay, at that price level, and I'm going to scroll you back in time to where the last time we were at that level. And the last time we were at that level happened to be right over here in September 2009. So what we're saying is that market forces are in order. And when did we actually know about that? We knew about that actually. The first time we knew about that was when we issued that signal on May the 2nd. Okay? Then once we got underneath this yellow boundary, that was the first confirmation that there's going to be an acceleration if we clear a complete bar. But you can see so far this bar hasn't cleared completely. There's just a piece of the bar today that is still touching this boundary. Let's say tomorrow we get a complete day of trading, whether it's tomorrow or any time going into, let's say, going into August this year, that we get a complete bar trading underneath 13,699.56. Okay? And the reality is we're at 13,601. So unless we get a 100-point rally or more tomorrow, we're going to have confirmation that this is going to want to do a rapid acceleration down. And there really is no support until you find a boundary that is sloped down. And we don't have any boundaries here sloped down, lower boundaries, until you at least get into this period in the June through August area, okay? And basically that area starts off as high as 12,707 and goes as low as 12,352, okay? And that's what I kind of meant when I was giving the S&P analysis, that even if we do get a rally, and I would expect some form of a rally off of that point, it's going to be limited to the yellow line. So yes, people that are short too much could get themselves into real trouble if they stay too short without having tight stops. And it could be a really wild year, because if we do end up getting a rally back to this yellow line, and we will give notification and updates as we come down to these levels and then follow through. If we do get a rally back to 13,677, that takes us all the way back to where we are today, which is where we are in the Dow today at 12,400, and where we are in the S&P at 1305 area. And that basically means that some of the individuals are going to feel rather bullish in a sense, because it's going to be very, very negative for traders. But then if we get this huge rally, everyone's going to think again, oh, everything is okay again. If you could just wait one moment, I just got to adjust one thing here.
While Efrem's on hold here, I would like to encourage you to go ahead and continue to type in any question.
I'm back on right now. So.
Yeah, good. Efrem, we have a question from Mark Shore. He says, is it true the capital markets index includes both equity and fixed income?
The capital markets index includes equity and fixed income, but what I'm going to show you over here, I'm going to take you actually to the CPM KTC, okay? And excuse me, let me just make sure, KTE, which is the capital markets equities only. It's made up of two components, the CPM KTE, the equity component, and the CPM KTB, the bond component. And what you will even see in the equity component, here it is. It's the same thing, no difference. We're right in the inflection point. We've broken below. It's actually even worse. We actually are confirmed. So equities are even worse than bonds. We actually, unlike with the bonds, we were unable to get a complete bar underneath the yellow. Today, we had confirmation in the equity component of the index. So what I'm really saying is that equities are leading bonds lower. And when I say bonds, especially corporate bonds, high-grade corporates, okay, and I'll show you another chart shortly that a lot of hedge fund managers look at, and it's the iBox LQD, okay, representing high-grade corporate bonds, and it also has a very, very similar structure indicating the same thing. So when you have all these components, from indices to exchange-traded funds, all indicating the same kind of pressure, it's not only saying that equities are coming down, but it's saying that all asset classes are breaking down at the same time, along with a lot of the commodities, as well as the currency markets that are tied to commodity-producing company. And what that basically means is that there is no safe haven, and that will yield a liquidity crisis and a potential flash crash. But I wouldn't say a flash crash, you know, is probably not as bad as what I see here, because a flash crash pretty much ends. It's a one-day event, and then it pops back. Here, yeah, it's possible that during the episode of selling, you have multiple episodes of flash crashes. But even if there isn't a flash crash, it's a persistent decline in price over a very long period of time, which could really start to get at retail investors, and you could get a large-scale capitulation in the market. So in the capital markets index, right now it's at 12,172. The red boundary, there's no support in equities until 11,759. Okay, so and today we fell about 200 points. Okay, and that represents 1.6. So, you know, we're likely to see even a bigger move down than that in the coming days. And as soon as we get underneath here, there's absolutely no support until 10,568 to a low area of 9,982. And this support area, look, if you get underneath this area, sure, you could go lower, but that's about all we could really say for this piece based on the information we have at this moment about where the acceleration, how bad that risk window could actually get. Now, in terms of going forward next year, you could see what's already happening. This blue boundary is starting to flatten out and actually slope up. And if I zoom in over here, you could actually see it's starting to just rise slightly. And that date is right around December 3rd. In the S&P, it's around December 7th. In the Dow, depending on what index in the S&P, it ranges really from November the 28th out to January the 11th. But the key thing to take is that if the market consolidates in that period and then breaks down below both this black boundary and this blue boundary at the same time, then the next gap will be the biggest sell-off, and that will take you down to 7,600. And unfortunately, 7,600 area is basically, you know, takes you back down to where we were in May 2009, right after the bounce off of the low. So, you know, that's low enough, and hopefully the market, you know, will find support. I highly doubt that it will, and there's a reason for that. There was an old index that was made on this market, and I just want to show you a very ominous sign of why I think this is going to happen. I'm going to take you back to the index at that time before the 2008 crisis, and the symbol for going back to the old index is, instead of it being CPM KTE, it is $CPM KTEX.X. Okay, and when I do that, it shows here the equities index old, and you'll see what we saw. This is exactly what we saw back in 2008. We had a boundary starting to curl underneath another boundary, and that would take us down to the bottom of the next boundary. And it's exactly what happened. the market came crashing down afterwards. Okay, so that's a real situation. Now what I want to do is take you to the corporate bond market and equity market, what we saw at that time. So CPM KT SX.X, and you're going to see a very similar structure. You're going to see that here's what we had. We had, if I zoom in over here, we had a situation where a shorter term boundary was curled underneath a longer term boundary. Price got underneath it and then started gapping. Everything started going flat and horizontal, sloped up, and we all know what happened in 2000 and later in 2008, getting underneath that yellow line, and then we gapped. In this case, the first level was down to this area, and if I take us to a weekly chart, you're going to see the big picture signal. This is just on a daily chart what we knew. Here's what we actually had in 2008. We rallied back from that. This is actually a rally that started back in 1982. Okay, actually, you could even take it back to the 70s. Okay, and we had multiple setups. Right, we had a setup here where we had the white boundary curled underneath the purple boundary, which takes us down to the purple boundary, but then it finds support on the black boundary. Then basically we have the black boundary underneath the red boundary, and we said at the point where it inflects down to the bottom of the boundary. So the target on this index is actually, and it's not, and the targets don't have to do with that exact date, it has to do with the target in price, but you're going to be capped by any boundaries that are sloped up. So basically 2,492. So we're still sitting with the situation that the signal that triggered, and that trigger basically anytime after May the 1st, 2009, basically any price getting underneath 10,807, okay, would yield a move down to that area. Now, the thing is, in this episode, as the market starts breaking down in 2012 and 13, we are going to go below that area. And when that actually happens, you know, over the longer term, meaning that in 2013 and 2014, we stand the risk of having like a 70 to 80% meltdown in the broad equity as well as the corporate bond market. And what I'm going to take you to is the iBox LQD, which is basically the investment top index. So it basically represents bonds, high-grade corporate bonds. And what you could see here is that in 2003 it made a peak. You could see just before the 2008 crisis it made a peak and then sold off. What does it mean? Well, usually the bond market, traders in the bond market are a lot smarter than traders in the equity market. It's usually a more sophisticated investor. It's also people that are closer to the company and know more about what's going on in the financials. And they'll usually give you a lead indicator of what's happening. And really, when you take a look at it, what you'll find is that even in 1987, what happened in March, and in fact in March before the October 87 crash, you had corporate bonds starting to be impacted and giving signs that there was some kind of break that was going to happen in the equity markets. Same thing happened here. You know, corporate bonds were starting to break down in April 2008, and then you had the crisis afterwards. And you could see it really escalated when I zoom in over here when we got underneath these boundaries that were sloped up in this yellow boundary, okay, and then it acted as resistance. Now, what you see here today, and this is a really serious situation, much worse than 2008, because in 2008 we didn't have the money printing that took place back then. We didn't have the search for yield that was so bad because interest rates were so low. So in this situation, what we have here is we've got this teal boundary curled exactly under today's day. And do you see? This week was one of the biggest reversals off the top, okay? And it's now sloped up. We actually indicated that way back over here that it was going to actually be bounded by the top of this boundary. And basically, what's going to end up happening, it's the same thing that happened before. We're going to be coming all the way back down to the bottom of the yellow boundary. But do you see the distance between the top of this yellow boundary and the bottom of this yellow boundary? Way bigger than the distance in the equity market. So the biggest crash risk and the biggest black swan risk in the market is a breakdown in the corporate bond market. And why is that a big risk? Now, nobody really knows exactly what happened with JP Morgan and their credit derivative exposure, but some of the talk was that they actually had some bets on that were tied to corporate bonds improving in the United States. And I believe that's why when he made that, when Jamie Dimon made that speech the other night and said that there could be further losses, he already knew that we were at a relatively high level in the corporate bond market, and it was just starting to roll over, so he was probably anticipating some extended move. But I'm pretty darn sure he's not anticipating this kind of move, because when you have a derivative exposure in the hundreds of billions of dollars and you get a move like this, and I sure hope that's not what they have, yeah, you've got a crisis that will make Lehman look very nice. And the thing is, it's not so much about JP Morgan, it's also about any other, like what other banking institutions that don't have the credibility of JP Morgan, that aren't talking about positions that they have on because they were making a bet for higher yield in the high-grade corporate bonds. But you know what? If the whole world knows something, it's usually a bad trade. And the whole world knew that. And what's going to end up happening is, as people start losing a whole lot of money in the equity market and commodity market and currency fluctuations, which aren't good when and especially in commodity-based countries like Australia, and I expect those to continue, you end up getting situations where they get margin calls and they make decisions that aren't totally rational, and they start getting out of other securities that they might not have otherwise, and that opens up the gates. And in this case, right now, the way this is set up, this red boundary, this upper red boundary here, is the resistance for corporate bonds going right through to the end of the year. And you could see the resistance, the highest it could have gone, okay, was 118.81. But every time it goes, but the point here is that it's capped by this red boundary and this white boundary. So once it gets underneath this white boundary, and that's at the price level of 114.27, it's capped by the white boundary, which doesn't really go any higher. It's actually even a little lower than the top of the red boundary. So all that this could do is just build a consolidation at the very best, at the very best, build it, and then basically break once it gets underneath this teal boundary, which is at 112.63, and stays underneath there for, let's say, 1 week, complete trading underneath there, not closing below it, but the high of a bar on a weekly basis underneath it, okay? Then you are basically talking about a move that is going to go straight down, and pretty much go straight down until you're at 93 to as low as a level of 87. And you could see in the future here that by that time people are going to be over short, and we're going to be looking for buy signals because this boundary is starting to slope down. But that is dangerous, because if I draw a horizontal line across the screen at where this is sloped down, or at the most extreme area over here, you basically get a situation that takes you all the way back to where we were in October 2008. But that was at a time when people were, at a time where people got in at this level, and it came down to this level. It's not just about how low you go. It matters from where you came from. And at this point, we came from a level of about 108. Now we're coming from a level of 115, and a situation where other markets are also breaking down at the same time. So this is a precarious situation. The next thing I would like to talk about, and it was the focus on one of the videos, I'm not going to go into as much detail as I did on the video, but it's on the website. It is the euro-dollar futures. And I'm not talking about the exchange rate between the euro and the US dollar. I'm talking about euro-dollars, which represent term deposits outside the United States that are in US dollars and that are getting paid interest based on the foreign country's rate of interest. Okay, and basically the symbol in TradeStation for euro-dollar futures is @ed.c for the continuous, well, actually @ed for the continuous contract. Okay, right now it's the June basis price. Last price traded at 99.50, and basically here's what we have. I'm going to take you to a daily chart so you can actually see it a little clearer. Okay, so here's the situation. When you look back to the situation in 2008, okay, you could see that when the market crisis hit in October 2008, what happened to Eurodollars? Eurodollars were skyrocketing. Okay, why were they skyrocketing? Well, let's just think about it. Okay, so let's figure this out. Okay, if Eurodollars represent U.S. term deposits held outside of the country but getting paid in the interest rate of that country, and let's just talk about Europe. It's not just U.S. dollars held in Europe. It could be U.S. dollars held anywhere in the world. It used to just refer to Europe. That's why they call them Eurodollars. But let's just focus on Europe. Okay, at the time, what happened in Europe? Well, let's take a look. Let's go to the euro. And we're going to go to the continuous contract, okay, for the euro, and go back to 2008. And here's what you see in 2008 with the euro, okay? Okay, so the euro started selling off like right at the time when the Eurodollars started rising, and then as we got into the crisis, we had a pretty big, we started to rally in the euro, okay, going into, you know, a rallying going into 2011. We also got a rally into 2010, you know, at fairly lofty levels, okay? And so basically what ended up happening is that because the situation, the negative situation in the United States due to the money pumping was causing interest rates to go a lot lower in the United States, what ended up happening is that money, U.S. dollar deposits from U.S. banks in the United States started moving to U.S. term deposits outside of the country and into areas that were paying higher rates. And at that time, the rates that you were able to get in Europe, which was, and it's called like the LIBOR rate, the London Interbank Offering Rate, which is similar to like the Fed funds rate in the United States, same idea for their country, and it was paying a higher rate. So basically what happened is money went there. But what's happening now is that because of the crisis in the Eurozone, money is now leaving the European countries, and actually recently, and I've documented that in our earlier webinars back in March, that there was going to be a flight of capital that was going to provide stability to the U.S. dollar. And it's kind of interesting because when you really look back at the U.S. dollar, and I'm going to go to the DXY. Let me just make sure that this is the current one here. Yeah, if I go back to the DXY, which is the U.S. dollar index, the cash index, and you go back to 2008, what you will see is that during the crisis, the dollar was actually rallying, okay? But then it actually started basing out in 2009 and then continuing. So it was trying to make some kind of a bottom. But if you go prior to that, you know, to where it made a peak in 2000, in the 2000 area, or, you know, early 2000s, up at 120, up in the 120 area, that's when the market was, you know, was at levels that were much higher, you know, than where we got down to when the markets sold off in 2008 in terms of the volatility. So basically what I'm seeing right now is because of the problems in Europe and the problems that are developing in Australia and commodity-centric countries, it's causing a flight of capital back into the States. The only problem with that is that the United, where's that capital going? It's going into securities, whether it's fixed income or equities that are overvalued. So there is nowhere to hide. It's not like before where you could run to Europe. Now you can't run to Europe and you can't run to the States. You can't run to Australia. You also are getting a bleeding effect right now in Singapore. Is starting to break down. India is being impacted. You have problems in weakening expectations in Hong Kong and China. So I'm not saying long term. Long term, China will play out, but that's a distance from now. And while the crisis is on, they rely a lot on the United States and other parts of the world being strong so we could buy their products. And that would impact them, and then them being impacted impacts us, because there's a lot of other countries that rely on basically China buying their goods, and obviously Australia is one of them. They're a close trading partner, and obviously with the expansions and infrastructure development that's taking place there to grow 225 new cities to move a lot of the middle class out of the suburbs and into cities, that requires a lot of industrial activity. But when things are weakening, that definitely shifts things. So you got 2/3 of the world's economy slowing down right now at a time when you're at peak prices in a lot of these areas. And right now, basically, I want to just take us back quickly to the EuroDollar, just to complete the analysis to show you what I see happening. And what's different about it this time is that this time we have a situation where, if I zoom in over here, we're up at an extreme going into a crisis in the equity markets. And we already have a situation where you see over here this blue boundary, this navy boundary is curled underneath this black boundary, and this whole thing inflects going into July the 25th. So that basically means, what does that mean? It means that basically we're capped pretty much close to the highs over here. And anytime price gets underneath 99.38, and I mean underneath for a full day, so the high of a bar underneath that level, and then you could get a major drop down to the bottom of the black boundary at the point where this boundary inflects. So we would come down and collapse into the 98.50 area, and that would represent a lot of the repatriation of US dollar term deposits out of Europe, and that should correlate quite well with what's going to happen in the periphery countries of Europe, as well as one of the larger ones that right now looks just horrendous, and I'm going to take us there, and that is the EWP, which is the MSCI Spain Index ETF, okay? And this is a call I put out way back over here when we were kind of where the red arrows were. That I mean, we had signals way before then, but I'm just talking about the most recent activity, is that we got underneath the longest term boundary. There's absolutely no support underneath here. And we made a call also that if we actually get a full week's bar, and I'm going to take you to the weekly chart because that's really where you have to go in order to see support. What you will see over here is that on the Spain index, and it's very different. It's much more bearish than any of the other countries. So as bad as Italy is and all that, yeah, they're going to end up, they're going to be impacted, obviously, and have severe problems. But this is going to be the one that this is the pilot light indicator for the rest of it. Okay, and I indicated that if we got a complete weekly trade underneath 22.30, you're going to get an acceleration. So it wasn't a confirmation thing that we didn't already know it was going to sell off. It's just about a statement that as much volatility as you think there is and price expansion there is on the downside, you see nothing yet until you get an actual high of a bar underneath 22.30. But because, and I was keying off of this yellow boundary because at the time the yellow boundary was a little bit lower. At this specific time, the yellow boundary for this week is at a level of 22.62. That basically means it doesn't apply to this week because we already are above this boundary this week. We need a high below it. So if next week the market stays underneath 22.88 all week, then you're going to see an expansion down to the bottom of the next boundary during the period where this yellow boundary and this blue boundary are on top of each other and overlap to the point where the yellow boundary inflects. And that inflection takes place into September 6th, 2013. So it doesn't mean that the move ends. It just means that the most dangerous period for negative news coming into the market to actually accelerate and magnify the capitulation of price on the downside is going to be enhanced. Okay? And also you can see over here in terms of retracements, they're not going to be very large, even if there is positive news, because you can see these smaller term boundaries are sloped up into this period. So at least going into the August 17th area, you're not going to be able to get back above this little area over here, even if there's a reflex rally off of much lower lows. Okay, but if we don't get underneath this area yet, we will get underneath that area. And how do I know that? Because these other boundaries are already extending well beyond there as you go into that later part of the year, into the mid part of next year. And that's what I also meant, that all sectors, including the bond market, the S&P, everything will be melting down then. But it's not like things won't be melting down now. There's just different phases of extremes. That will be the biggest extreme. Now, if we do get underneath here, then the problem is that there is that at the inflection point of this, even at, whether you're at this inflection point, which is at a level of 744, or at this inflection point over here on the blue boundary, which is the one that we key off of, that would be the objective, is about $5.28. Okay, so we're at 22.90 right now. That is an extremely large drop, and it's also the biggest gap between one lower boundary and the next lower boundary. So, and also, other technical traders are going to be realizing that that's important, because we had a major pivot point back in the lows of March 6, 2009 at a level of 24.86. That level was already taken out. But I don't go by pivot levels. I go by levels that are hidden to the market. And the reason why is because there are a lot of trading systems that are based on breakout strategies, and 80% of the time you're going to get chopped around like crazy. And in a highly volatile market, getting chopped and then going all the way back to a level is not very fun. And it just happens to be, in this case, we actually have a signature that coincides very closely to a level that other people are looking at. And that even makes it more serious, because it means a lot of the stop orders are not, stops aren't going to be pulled the other way. They're actually going to be pulled down. And you could see there really is no support, until you're back to the 2000 October 11 area at around 1471. That's what other people would key off of. But as far as I'm concerned, there's no support. So really, this is a hidden level that isn't obvious based on just having that one incremental piece of information of price getting below that yellow line, as I indicated. And that yellow line rises, right? It rises to an upper level of around like the lower part of that line, and while also being underneath the blue line, to around 26.20. So it's possible that if we don't break underneath this right now, I'll be just pushing up the stop level for the sell signal, to that level of 26.20. But in the meantime, it's for next week, it's sitting at that 22.60 area, but 22.30 is absolutely dangerous territory. So that covers the Spain area. I'd like to just mention the energy sector, because that's been a key area that's really been hurt in the S&P. And I would have to say that the consumer discretionary area and consumer staples have been one of the two areas that have held up fairly well. And there were a couple, and I always like looking at the areas that are at the extremes, because if I already know the other ones are weak and going down, I just want to know when the whole thing is going to topple. And, when the last man standing, that's when you got to, clear the room. And right now, the last man standing probably happens to be Colgate, because Colgate is the bellwether in the XLP exchange-traded fund for the consumer staples, which usually is a defensive play in a risk-off environment like we're on today. Now, if I actually take us to the XLP first, and then I'll show you the strongest link in the XLP, and if we could show when those are going to break down, that'll give you an idea when this market is pretty much finished and knocked out. And right now, with the XLP, and I first want to go to a daily chart just to see the near-term expectation. So right now, we're at consumer staples. This is the daily chart. And here is what I'm concerned about for at least the immediate term. And this is what's going to add to the selling pressure, and especially like when you look at the market breadth and find out that the next time there's a wave of selling, there's even more stocks that are participating, because you're soon going to have not even the consumer staples participating and holding up as this market breaks down, whether it's because they have to sell it because of margin debt on things that aren't working, or whether it's just because technically it's just too high and there's negative news that just comes out. Okay, so what we see over here, we see that white boundary sloped up underneath the purple boundary, and that is saying that we're coming back down to the purple boundary. and we already got underneath the purple boundary. We are capped by this top over here. These don't go much higher, and that high was made over here. So really, even if this thing holds up, as an investor, investors should not be thinking about buying into defensive plays and consumer staples. They should not be thinking about that because we're way too close to the high point, which is exactly where the high was, where we had our initial sell signal, and now we're getting into the area where, you know, you're going to form a consolidation and then break down towards this area. Now, okay, you may think, okay, big deal, so it comes down to 32, you know, but this is a very low volatility index. It is a big deal. Just the fact that it's not going up anymore is a signal to people that there's something wrong. And then when this thing comes down over here, let's say it bounces off of it, what's going to end up happening is it's going to cause these boundaries to start curling underneath. And then anytime there's a rally that's capped at this boundary near the high, it's going to actually form another sell signal, except this time the sell signal that comes in the third quarter is going to be with this yellow boundary curling underneath the navy boundary, taking us to the bottom of the navy boundary, okay? And that will take us all the way back down to 28.71, which is back to where we were in October of last year. That's going to get people really thinking about what's going on. Now, if we go to a weekly chart and look at the bigger picture, if we actually go back to the October lows, does it actually trigger any larger scale signals on this time frame? And what you can see over here, we have a situation over here where this black boundary is below the blue boundary. You can't see the whole thing, but in the future it's below. And basically also you can see that this teal boundary is underneath the yellow boundary. So technically, yes, the thing that could save us this year is support on this slope down boundary. So technically, yes, there will be support. And this isn't the worst index, but the reason why I'm bringing it up is I'm just showing that when an index that should hold up strong starts breaking down, and in this case we're talking about 3088 to 3021 is major support for the intermediate term. In the short term, you got some support at 32.12 and 32.56. But that's a big deal for this index because it's a low volatility index and people will key off of that. And then other sectors that are really weak will really start breaking down. Now I'm going to take you to Colgate, which happens to be one of the bellwethers in the Consumer Staples Index, or also known as the Consumer Goods Index. And it is much more ominous. And why I say that is because here's what we've got here with this. It hasn't broke down yet, but it's right at the top. And there's not many projections that go any higher. It's like 102. Like, what's the point? It's at 128. It's in trouble, okay? And it's got a few problems. Number one is it has this green line curling underneath the pink line, okay? And we're capped at the top of this blue line. So this blue line is capped at around 102.90. So it's a great area to be selling. But the trigger is basically if we get a, let's say next week we get a, or in the coming weeks, high of a bar underneath 99.41, that would then take us back down to the 95.45 to the 93.27 area, okay, in this area. Now, the real problem is that we have this white boundary curled underneath the purple boundary, which will take us to the bottom of the purple boundary, and that would trigger if we get a high of a bar underneath 93. So it's like one signal bleeding into another signal, okay? And then if we're going to come down to this level, the problem is we also have the teal boundary curled underneath the yellow boundary, which is going to take us to the yellow boundary. So it's almost like a game of dominoes. Once everything is lined up, you get a cascade event, like a chain reaction that comes out of nowhere, and and it could take you all the way back to $58, which is a huge move, and that would definitely be the pilot light indicator for the demise of the consumer staples, and that would pretty much end the last defensive play in the market. Outside of natural retracements that take place during the year, like I said with the S&P 13, you got your 1365. 1385 at the most, but in the meantime, you've got huge risks down into the 1100 and the 1000 area, and even worse than that, we also have the black boundary sloped underneath the red boundary, as we get to the end of the year, when everything starts going down and things all curl down once you get into that May period, like where I'm saying things happen. So in that situation, yeah, you could come all the way back down to $20. I'm not saying it's happening next year. Just the fact that that setup is there should be enough to scare someone. And from a trading point of view, it's not about saying that, okay, we have to go to that target to make money. The point is you've got one signal, two signals, three signals, four signals, all telling us that prices are progressively going down. And just even a price coming down to this level is enough money to make. You know, it's enough risk. Forget about the money. If somebody's long, it's a very dangerous time to be long. So that's Colgate and the consumer staples. Now, the other area, as I indicated, that has held up strong, and we should talk about, is consumer discretionary, the XLY. And recently, I put a number of tweets on our website, as well as risk windows on, that actually identify some areas of trouble for a number of equities in that index, and I'll mention them briefly shortly. I just want to just show you the risks that are inherent in this index. Okay. Well, you can see over here, it's not a surprise that this started breaking down over here. Okay. Besides the fact that if you drill down into the actual equities that make up this index or this sector, what you'll find is that they had a lot of perfect sell signals. But here we had the purple boundary sloped underneath the blue boundary, so we're expecting to gun to the blue boundary. But at the same time, if we come down to the blue boundary, we also have the white underneath the purple, and that basically opens up the risk down to this boundary. But at the same time, we have the yellow underneath the blue, which is going to then take us down to the blue boundary, and it's sloped down. So our actual tail risk for the XLY is back to 1950. And if I draw a horizontal line at that point, what you will see is that that takes you all the way back to where you were in 2009, right in the March 27th area. Okay, so this entire money pumping, not only was it a waste and caused all kinds of currency problems and a crash and a coming crash in the corporate bond market, but it's also you know, going to end up in the same spot again. And the fact that the risks are there and there's really no upside, and we call these things risk windows, okay, just for our terminology, and it represents the period where risk initiates, and then the ending point is basically the lower part of the longer of the pair that is curled, and it happens to be the blue boundary in this case. So very, very dangerous scenario there. And actually, a couple of calls that we put out in that space, and you could actually see the webinar details. It was actually put out in a quite timely fashion before the earnings were actually announced. And that was done with two equities. It was done with JWN, Nordstrom, and we all know that Nordstrom's earnings came out negatively, okay, and that was quite anticipated by the orientation of the setup. And it's not like the setup is, it knows everything. I mean, really all I'm trying to know is how people are going to be perceiving changes in risk and changes in momentum. Reality is all about perception. It doesn't mean that I have insider knowledge about, you know, that these lines somehow on the screen tell me that there's going to be negative news or positive news. It just happens to be that whether there's positive news or negative news, people's perceptions are going to change when those boundaries start sloping up or when we get signals. And that tells us something about liquidity in the market that balance sheets and valuation can't tell you. And that gets you out of problems when there is no news to actually get you out of the market. And what happened over here is that we had issued the signal back over here, okay, and we had a number. You can see over here we had the white boundary curled underneath the purple boundary telling us we're coming down to the purple, which we're just about there. But at the same time, you can see here we have the teal boundary. I'm going to zoom in a little more so you can see it. You can see the teal boundary sloped up underneath the yellow boundary, which basically means we're going to come down to the bottom of the yellow boundary. That's why I put these upward arrows there saying that, hey, if it comes down there, it could bounce off of it because it's sloped down for a bit over here, okay? But once you get underneath here, these don't really have to. Actually, these buy boundaries, we're really referring to the blue because it's sloped down a little, and then after there, everything slopes up. So really, right now, we're gunning for this area, which is 41.30 to 40.25. We were capped at the time at the high because these boundaries at the time were capped up at around the 58 area when the market made a high at 57.75. And then we actually mentioned on a tweet on May the 10th, before the earnings were announced, that there would likely be a large sell-off. And if there would have been good news, it would have just failed at this boundary that is actually sloped up in that 56 area. And that would have just been another opportunity to put a sell there, and it still would have come down to this area. But at this point, it was negative news. The market gapped down, and it's never looked back. Okay, and yes, this teal boundary is sloped down over here. So between here and where this thing turns up, so somewhere between here and June the 16th, yes, it's possible to get a bounce off of 44.08 to 45.41. But after that, there's, you could come back down to 40.14 to 41.30. But all bets are off because after August, if you get underneath 40.30 or $40.03, that's going to take you much lower. Okay, but we're not done our analysis, and this is what's really dangerous about JWN. And let's see if there's any other signals. Do you see here we have a small portion here where the black boundary is curled underneath the red boundary, and unfortunately the red boundary is all the way here. So it appears as if the tail risk for this stock is back down to 20 or lower, okay, as the events unfold into next year. And that's a real problem considering this was one of the big leaders during that rally off of the 2008 lows. The other equity, which is a big one in the Dow index, and is Disney. And actually we put out a call also just before earnings the other day, before they were making that announcement regarding how well their show was doing. They made $200 million in the box office in their last release. But you know what? In that case, they came out with good earnings. It's the exact opposite. It was good earnings, good news, but the stock still sold off. So like I said, when you have these signatures in place, what it's really telling you is how resilient the market is going to be on a forward-looking basis to good or bad news. And in this case, people are going to be perceiving good news as negative news. And that's why, a lot of people, get the question, well, why is it that the market went down on a good day, on good news, and up on bad news? Well, you know what? It just happens to be that the orientation of their perceptions were different. So you really got to look at the context of the perception space across all time scales. And unlike some trading strategies that look at multiple time horizons, they don't look at it in a synergistic or holistic way. They'll look at time horizons independently. You may have a short-term saying to buy, a long-term saying to sell, but they don't understand the social networking dynamics and the science of the interaction that's taking place from a short-term time frame to a long-term. The way I see it is long-term time frames act as constraints that allow short-term cycles to actually play out their pattern that other people only see in hindsight, so that later on, once they start seeing the opposite pattern and they take on a different position, then the long-term smart money starts accelerating in the direction of what the short-term traders are doing, and you end up getting large-scale moves. So it's very key to understanding that you can't just do a voting strategy and say, oh, I've got 9 buy signals or 9 sell signals on 9 different time frames, and I've got 2 buy signals, therefore it's a sell signal. It doesn't work like that, because if you're at the end of a cycle, you only need 1 buy signal to tell you that it's the end, because always the longer term cycles are going to always lag. And the whole idea of these boundary conditions is to tell you there's not only is there 0 lag on these boundary conditions, it's a negative lag, because we actually it's a reverse engineering of what MACD and RSI are going to be showing traders in the future at all different time scales and overlaid all at once on price, where MACD fails in that regard because MACD is not bounded. It's possible to have a higher level of MACD but a different level of price. And also, MACD doesn't tell you where in the future MACD is going to be crossing 0. And crossing 0 is a very key indicator of whether you're going to be going positive momentum if you're crossing above it, or negative momentum if you're crossing down. And in our case, the interpretation is boundaries that are sloped up mean that MACD is actually going to become more negative, because if this represents 0, then any prices underneath of it become bigger away from it when they're sloped up. When they're sloped down and you just go sideways, then you're actually, and you're above it, then you're more positive if the slope is down. So that's why I've been saying that. When you see the slopes up, it's bearish, and when you see them down, it's time to buy. When they curl, you sell again. Now, in Walt Disney, what you see over here is a problem, and we've actually been selling off since our signal. It's a problem because we have the white boundary curled underneath the purple boundary, which is putting us at risk down here. But then there's some support for a short period into June because we have the white boundary slope down. So there's support into that $40.77 area, okay? And also getting underneath 43.74 on May the 21st, after May 21st, or even doing that, getting underneath 44 after June the 12th, if it doesn't already do that prior to that, would be bearish. That would accelerate it down there. But also on top of that, we also have the yellow boundary curled underneath the blue boundary. And like I said, you go to the bottom of the blue boundary. So we've got risk all the way back to 29.19. But just like with Spain, remember when I indicated that if you have a situation where two boundaries, lower boundaries, are on top of each other and they start sloping up, which is quite a possibility in the first quarter of next year, if you get underneath $29 on a high basis, then you could come all the way back down to $15, going in through 2013 and 14. And don't forget, all these other boundaries are sloped up. So even if you do get rallies, which we will provide indications where they come in and also indications where selling could come in, you're going to be bounded. So this is a major, major reversal on a multi-month and multi-year basis, and it's a big Dow company that's been holding up, and that's only one of the components. There, we've identified a number of components in the Dow that are going to be exceptionally weak, and that will be available to subscribers of our service. That will be rolling out in the coming week or so, and just stay tuned, and we'll also send out information to anyone that actually opted in at the top of our website for our update information, and we will keep you abreast the latest developments that we see in general, and then of course as soon as we launch our products, we will actually provide products for institutional as well as retail traders regarding these high definition risk maps. The only other Dow component that I'm willing to share today outside of what is going to be available to subscribers is XOM, because it happens to be in the XL, component of the XLE energy index, and one of the most dangerous components in the index, also a component in the Dow, and components that happen to be in more than one index tend to be watched closely and tend to be held by a lot of people and overcrowded. And it tends to be situations like those that when things happen, eyes start watching and then it starts impacting other sectors. So we've actually put out a detailed video alert on this. You can go on to Naked Swan Trading under video alerts. You'll see that for Exxon. It was made prior to this sell-off, way back over here. And basically, why did we make that? Why did we issue that announcement? We issued it for one main reason, because this blue boundary started curling underneath this black boundary, and not only is it curled underneath it, but it is curled and sloped up for a very long period going forward. And basically, we're talking about coming all the way down to the bottom of the black boundary. Now, fortunately, we've got a longer-term boundary, the red boundary, and the reason why I say longer-term, because it's the one that actually is longer. So there, and because it's sloped down in this area, there could be, the tail risk is down to about $58 to $56.61. But considering that the stock came off of around 90, that is a huge haircut and an enormous component of the Dow and a very large component of the S&P. So it's certainly going to have an impact that will affect the marketplace. And so that pretty much identifies those areas. What I want to just take you to right now briefly is something a little bit shorter term that we could key off of over the next few days. So I'm going to take you to the QQQs, okay, the power shares, and I've been putting out a number of tweets in the past number of days, all the way since all of these little dead cat bounces that took place, and there are a number of tweets, very precise ones that said that in the early morning, if we get close to 2 in the afternoon, we saw a curl in one of these boundaries, and it was going to roll over and never look back. And there were about 5 or 6 of those for short-term traders that were put out, and they all happened to work well in advance. And many of them right to the penny, or within the penny, and a lot of them right to the minute in terms of the reversal. Now, to have a successful trade isn't always just about timing. It really comes down to knowing where the retracement points are, where the risk levels are, and whether the trade is worthwhile to take for the transaction costs that are applied to the trade. And what happened today in the NASDAQ is a very, very dangerous situation. It's dangerous because, number one, well, let's take a look at this. Dangerous because we have the blue boundary that has curled underneath the black boundary. And we all know what that means. Say hello to the black boundary. And the black boundary just happens to have a bigger gap between the navy and the black than it had between the yellow and the blue. So that gives us the indication that volatility is going to expand. Okay. Now, if volatility is going to expand, a lot of people right now in their systems are thinking that, oh, we're oversold. There's really no such a thing as oversold, first of all. I mean, depending on what time frame you're on and what indicator you look at, there's an oversold condition at every second in the marketplace. But what we really need to know is the forward-looking map of where you're actually going. Because if you actually had an idea that you're going down to these levels, then you would understand that the context of the oversold is pretty much irrelevant, partly because if I zoom in over here, what you will see here is we have a whole bunch of boundaries that as this market started coming down, it caused some of these boundaries to start curling up. And what that means is that longer-term, intermediate-term traders, longer than these really short-term traders from these smaller lines, are starting to perceive negativity as we go, especially into the end of May and early June, which basically means that even if you have the best news report and all these things, it's going to fail. Those rallies will fail, okay? And they're going to fail. I mean, the lower end where they will fail, they'll fail along this black boundary or this red boundary. So in the best case scenario for the bears, that's where they're going to fail. The black boundary starts off at 62.42, and then by the end of May for the red boundary, it ends at 63.77. So that's an area for the best case for the bears. But technically, from natural retracement point of view, wherever you have the situation where these boundaries start sloping up, you're going to find resistance in there. Plus, you've got these longer-term boundaries all sloped up. So you're not going to be able to get above this area that we broke out of. Okay, so basically what this is indicating right now is that even this area over here, which is 64, and this lower area, which is 62, we have a situation because this boundary starts spreading out into the future. What we should key off of for knowing where the trailing stop is for the move is this upper purple boundary, okay? And it starts inflecting up over here. So in the best case scenario for this market, which I'm not predicting it one way or the other, I'm just saying that there's extreme risk down here. It's going to end up down there, okay? But if at some point, let's imagine price comes down, let's say it comes down to 60.90 and then decides to do a rally back up to this area, and then this purple boundary comes down to it. That purple boundary is going to act as resistance to keep us in the move, and eventually this purple boundary will actually come down to where this price is going to meet up at the target objective, okay? Target objective, okay, you're going to come down to the black boundary, but because it's still sloped up, there's nothing acting as solid support until you're actually down at 52.46, Okay, so that's the downside risk, which is huge for the Qs. Okay, now in the event that we don't come all the way down there, we're going to be using this purple boundary as the stop to keep us in. And what's going to end up happening is that when we come down to this boundary, this purple boundary will probably be somewhere down at 59.46. You'll get a consolidation, and then it'll decide to break above, say, like $59.80, if indeed it wants to go back up. And we'll give an alert if those conditions set up at that time. But in the meantime, this is what the tail risk is for the NASDAQ on the very short, on a 144-minute basis. Now, the scary part is if we actually go to a weekly chart on the NASDAQ, and then I'm going to take you to the NASDAQ composite because it's a broader base of the NASDAQ. NASDAQ 100 is only the 100 stocks. Let me just clear up the screen here so you could actually see things clearly. So, okay, so the danger in NASDAQ is this, that we have the situation where this purple boundary is curling underneath the teal boundary, okay, and basically this red boundary long-term is acting as critical long-term resistance. So even though this market rallied up as high as 68.55 on April 6th, it could have gone as high as 71.74. But that still wouldn't change the fact. It would have even made it worse because it would have mean the second it got up there, it would have collapsed anyways. What's the point of going up if it's just going to come down? I mean, you invest if you actually think that you don't have tail risk to the downside and it's just a normal correction and then you go higher. In this case, it's the exact opposite. It's an asymmetric trade. It means that your risks are higher on one side and lopsided to the downside, and more risk if you actually go long the market. Okay, so technically, so our issue here is that if this is sloped underneath the teal boundary, our risk is to the bottom of the teal. But the problem there is that this yellow boundary almost got underneath the blue boundary, which would have said that we're coming down over here. So we don't have definitive proof right on the Qs that we have to come down here. But you got to remember the Qs are an ETF that haven't been around as long as the NASDAQ. And it's the NASDAQ cash market that is harder to manipulate and that controls the market. So if we go to the broader market, which is the composite, the NASDAQ composite, it's hard to imagine that if you get a complete crash in the NASDAQ composite, it's not actually going to flow through to the Qs. And what you will see over here is we have a real problem. The problem we have on the NASDAQ composite is that we actually, not only do we have the teal boundary underneath the yellow boundary, which is going to take us all the way back to where the yellow boundary is sloped down, which is at a level of 1402, and we're at 2813. So we're talking a 50% haircut. But on top of that, we also have the yellow boundary sloped underneath the blue boundary, taking us down to the blue boundary. It just happens to be that the blue boundary happens to be in confluence with the yellow boundary. So I guess the question is, well, does it really add any new information? Because we already know we're going to come down there. Yes, it adds more information because it tells you how you're going to come down there. When you got more than one boundary condition joining in with bearish perceptions, then rationally what that means and logically is that the selling pressure is going to dwarf any kind of buying that could come in at shorter term time scales or any kind of buying activity that the Fed could actually do to prop up the markets. And it's going to basically, that is going to be a scary situation where policy errors can be made. So I would say that volatility could expand a great deal. And even worse than that, we actually have the black boundary curled underneath the red boundary, which is the longest term boundary possible. And basically, after October, if you actually get underneath 2720, and we already know we're going to be going underneath there. It just happens to be that, let's imagine you get a rally back to that level, okay, after coming all the way down to the level. And it's an automatic sell, because every time you go in there, it's just sell, because you're going to be coming all the way down. Your tail risk is down to the red boundary at the point where the black boundary inflects, which is at a level of 226 on the NASDAQ composite. Well, we're at 2,800, and the last time we were at this level. And I'm just saying that's the tail risk. It doesn't mean you have to come down to that level, but you know what? That would be a logical level, because if we come down to this area here, which happens to be just below those lows, natural breakouts a breakout that had that much of a right-hand side, that would be a normal kind of sell-off. And in that case, it would take you back all the way to where we were in 1982. So we're talking about completely correcting the move back to the October 29th high of 1982, which is kind of strange because October 29th was the crash in 1929. Okay, so now what I want to take you to is one last chart over here, and I mentioned that I would talk about it, and that happens to be the put right index as a better gauge for identifying investor fear than the VIX. So the put right index is PUT.X. Okay, and what you will see over here is that this is put out by the Chicago Board of Option Exchange, and yeah, that's for TradeStation, PUT.X. Maybe on a different system, it's a different value. But if I'm going to take us to a daily chart, and you're going to see an ominous signature and a very similar signature that we saw prior to previous crises. And I'm just going to take you back to just a few here. I'll take you back to the situation in May 2010. Okay, May 2010, what did we have? We had a situation where let me zoom over here. It's hard to see, even for me sometimes. So if I zoom in over here, we actually had the blue boundary just trying to get underneath the red boundary. We actually, what else did we have? We had the teal boundary underneath the yellow boundary, which had risk to come down to the yellow boundary, okay? And we got into that zone where these areas hit. And then also, here's the next episode to key off of. And you're not trading the put index. It's giving you an idea that when it's at a high level, that if you're in risky assets, you should be following the sell signals on those asset classes, but realizing that if people are not willing to sell puts, because puts themselves, people would be willing to sell them if they were bullish, because it's more of a directional call on risk. If people think that the markets are not risky, then they're more likely to put on option strategies that include selling puts. And but if the market actually tanks, then they end up losing a lot of money selling the puts, especially considering that options on puts get affected a lot more on fast selling than options on calls on buying a lot of times, because a lot of the panic comes in on the put side. And you can see here again in July 2011, we had the situation where we had a number of boundaries that were curled underneath each other, and it came down. Like here we had the teal boundary underneath the yellow, and it came down to the yellow boundary. Okay, so we would have known way over here that there was high risk in July, and then we could have actually found the sectors that had signals and then already got into that. But what you'll see here is the biggest signal we've ever had on the put right index that's downright scary. And what it shows here, it covers almost every possible situation. And you can see over here, when we put out the alert, we actually had the purple boundary underneath the teal boundary in the future. Okay, you got to remember, this is today, so we could already see the teal boundary here. So when we were at the high, the number of bars before today is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. That means that this boundary, all we were able to see was 12 boundaries less, so 12 bars less. So that would be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So we knew up until this point at this exact high, which basically means that we already knew that it was sloped up, which we knew that when we get underneath here, this was, so we had multiple things sloped. We had this slope with this one telling us we're coming down here. Simultaneously, we had the white underneath here saying we're coming down here. We haven't even got there. Then also we have the purple underneath the green saying we're coming down to the green, which is teal. And then we also have the teal sloped up with the yellow, and that's scary because yellow is all the way down here, and it's sloped down. So you do have support at 955 and also along the blue boundary at the higher end at 987. But we're at 1140, and if you go back to the last time we were at those levels, that was in October 2011 during the crisis that was taking place in Spain and in Europe. And now we're in a much bigger crisis with the EWP in Spain threatening critical levels that are going to potentially take us back to where we were in 2002. Okay? And even scarier than that is that we have this black boundary curling underneath the red boundary while they're both sloped up. And the scary part is the bottom of the red boundary is here. It happens to be down at 682, which is basically saying that the last time we were at a level like that was not since, well, basically, it's off the charts. They didn't even make that index before then. So basically, we're talking about way below levels of 2008 in terms of the panic that is going to be felt in the market. So even if prices don't go as low as 2008 initially, the speed and the surprise of this event is going to be unprecedented. Okay, and how big it even seems in the near term, any retracements that take place in the latter part of the second and third quarter will be followed by even a larger scale surprise, and we will be updating you on those details as we move forward. So that pretty much outlines some of the key areas I wanted to look at. For quant traders and institutional traders, I just want to add one piece of information that kind of ties it all together. So far we talked about tail risk, okay, which is a big thing for institutional traders. Another big thing, component of interest for institutional traders is something called basis risk. And what basis risk, for those of you that are not familiar with it, what it represents is the ability for a hedge to work. And now, for a hedge to work, and this would have helped J.P. Morgan a bit, is that in the event that you have a security that is moving in one direction, you want to offset that risk in a security moving possibly in a different direction. The problem is, if one security moves in the opposite direction at a different rate, then you could end up getting a situation where you don't have a perfect hedge. Not only not a perfect hedge, but a hedge that becomes less of a hedge over time and more like turns into a speculation on both sides of that hedge. And in the context of what I'm looking at right now is that a lot of individuals right now are thinking that the bond market, if you're diversified across different asset classes, like real estate, the bond market, consumer staples, that everything is going to be fine, and commodities. But there comes times in the market where the perception space, which happens to be this map of these zero momentum boundaries across different time frames, are shaped in a certain way that no matter what kind of information comes into the market, they are going to be perceiving negativity or positivity. In this case, it happens to be negativity. And in this case, it just happens to be that as we get closer and closer to the end of the year, everybody, like in 2008, is going to be seeing negativity in almost everything and all asset classes. And when that happens, there are no hedges that work, because then it becomes driven by liquidity and not based on fundamental and intermarket relationships that normally hold. And without actually keeping an eye on those changes in liquidity through this perception space of how humans look at information, there's really no way to determine how there's going to be divergences between the indices and why market correlations are going to be breaking down and approaching unity. And when that happens, and what it means is that if the correlation approaches 1, everything moves in the same direction and you can't get the diversification. And even worse, a lot of the big funds, to get diversification, they try to hold a lot of different instruments, which means that not only are they going to be diversified with basis risk, meaning that they've got risk where both sides are going to turn into speculation, but they're also in a lot of areas where it becomes difficult to unwind. And you end up, having a situation where it becomes costly to unwind those positions both in terms of transaction costs and in terms of actual market liquidation costs. So that's the other big issue there. So anyways, that pretty much covers what I wanted to talk about. If there's any additional questions at this point, I would be willing to answer those.
Efrem, we have one question. James has been very patient and hanging in here with us, I think, possibly to get an answer to it. He says, Efrem, do you look at the T-bond market? If so, where do you think the market will begin to stall? Thanks, James. Anybody else have any questions? Feel free to type them in before we wrap it up.
Okay. In terms of the T-bond market, obviously that's different than the corporate bond market, because in the corporate bond market, it's companies. They can't play games to the same extent that the Fed could play games and just keep on pumping money, into long-term bonds and keeping them elevated. And also the perception that some retail traders may have that if they buy bonds, that is the safe haven. It just happens to be that when that low comes in the market, and bonds reverse, unfortunately, they're going to get hurt again in another market. So back to the this is the 30-year U.S. Treasury bond market based. Okay, and right now we had a nice rally in the past day today up to the 148 12/30 seconds area. Now what you can see over here, this is rather interesting. Do you notice here how the yellow boundary is starting to curl up underneath the blue boundary? And as I've indicated before, that indicates risk down to the bottom of the longer boundary of that pair. And that curl happens to be centered, that inflection point happens to be, well, there's a couple areas, but really this is the last area. So it's right around the August 23rd area, and then is a little bit of one August 31st. So towards the end of August, the earliest August 2nd. So in the August period, early September period, this thing starts inflecting. What does it mean? Well, what it basically means is, like I indicated before with the S&P, when you get a high of a bar completely underneath this area, that area at this point happens to be the 144 and 12/30 seconds. So if you get a complete daily bar trading underneath 144 and 12/30 seconds, then that opens up an acceleration to the downside. Okay. Now at that time, you could see here that these boundaries here are sloped up. So it means that there's not going to be a great deal of support at the 135.23. Yes, you may get a bounce intraday and be capped underneath 139, but really until you find a boundary that's sloped down, and you can see this red boundary slopes down until around November the 28th. So you've got support into 125.31 30 seconds and the higher part around 127.5 30 seconds. Okay, but the key thing is you need to get price underneath here. Price doesn't get underneath there. This technically, if the government wants to continue pumping money in, they could take this higher while the equity markets continue to go down. But here's what I would key off of to determine when this is going to be less resilient to purchasing, less resilient to the government purchasing bonds, and when the natural levels on the upside will likely get hit. Now, just like with Spain, I was saying if you have two lower boundaries that happen to be on top of each other and overlapping and price breaks underneath it, it's extremely bearish. It's the same thing with the upside. You can see over here on bonds, we had a situation where the purple boundary and the teal boundary were on top of each other, and they're still on top of each other into the end of May. Getting outside of that, you then get a the reverse capitulation, so a rally that continues, okay, and there's an apex in this point at a few points, one around June the 7th, okay, which for people who happen to follow the Bradley model, which is not part of this methodology, but it just happens to be that that's one of the Bradley dates for market timing. So it's interesting because a lot of times T-bonds will actually make a peak one way or the other around those dates. So it's something to keep in mind. In terms of price-wise, you can see over here we've got the yellow boundary sloped up until around May 23rd at 150.26 and 150 and 3/30 seconds. But after that, it starts sloping down again into that into that period in August. So if you get on the other side of that, this yellow boundary will act as support. There's two ways to get on the other side. One, price breaks above it over here, or price just tends to just go sideways, staying above this area here, and gets on the other side just because of time. Either way, the next time price gets underneath the yellow line later in August at 144.13/30 seconds, that's where you've got, the big risk to the downside. In terms of the upside, well, the rule is this, that once a market starts curling to the upside, a pretty good gauge of where the buying would stop at an extreme level, and anything beyond that is just insane, but would basically be the highest level of the boundary following the boundary that is curled. So in this case, without getting into too much technical detail, price-wise, this is 152.30 seconds, and let me just do one little bit of analysis here, and then I will get you the answer. Okay. $157 would be the tail risk to the upside. Okay, so that would be pretty much about as high as they could take it to the upside, outside of getting any shorter term signals that take us back down. But in terms of the big picture, it's this level where you actually get the complete reversal of the bond market that took us up to this area. And then in the short term, if you end up, let's imagine as we start going up, we end up getting a situation where this white line curls underneath the purple line, then yes, you could come all the way back to the purple line. But that still only takes you back to where we were, back at the lows in April the 3rd at 136. And most likely that would occur at a time when you're getting an upside retracement in the stock market, because it's usually in a deflationary environment, bonds and stocks move opposite of each other, as opposed to in an inflationary environment when the economy has higher GDP, then technically bonds and stocks move in the same direction. Okay, so basically in this case, let's imagine that we get that big sell-off into June, July, and then you get a retracement for a month or two, bouncing between the lows and not really like capitulating like it has been in the past few days, more like just gnawing down slowly, going up, and then forming some kind of W. While that takes place, that's a sign to the bond market that, okay, the risk may be coming off for, at that, they may be thinking it's off for good. We're saying basically that it's just a short-term dead cat bounce on an intermediate term scale, but that will fail by the third and fourth quarter. And then during that little retracement to the upside on the S&P, when that comes in and when we alert, then that would be when the bond market could sell off and form those signals that could take us back here. But this is the big one. The big one is the worst case scenario would be a rally to 157, and if they take it higher than that, you're in a complete bubble. It's already a bubble. I mean, the idea is once you get this curl, it's a bubble. So when people say, when are we in a bubble? You're in a bubble the second the market rallies towards the high and you get a curl. Because at that point, that even if it's going to go to the next level, which is potentially 157, it doesn't have to go there. It could fail at any time if it decides to get underneath here. But if it gets there, it just means that, well, why would you want to buy it as an investment, especially like considering that it's a 30-year investment where within a matter of months, it's just a small movement the other way is going to actually create a lopsided trade back to the downside and take you, and cause you to lose a tremendous amount of money after getting chopped up in the equity market, then to get chopped up again in the bond market, And when I say that, I'm talking about the the government bond market as opposed to the corporate bond market, which appears that it's not going to have a good time, regardless of what the government does to the long bond over the intermediate term. So I hope that answers your question regarding the U.S. dollar. I mean, regarding the U.S. Treasury bonds, 30-year.
Okay, yeah, James says, thanks, I'm definitely short right now, so that helps a lot. Okay, James, that's great. Appreciate you being with us. John had one last question, actually came in early, and I don't know, Efrem, if you feel like you answered that with the XOM discussion, but real quickly, John is still with us, and he asked the question earlier, oil prices, are they headed up or down in the short term? Please advise, thank you. And that's the last question. That's the last question we have for today.
Okay.
And just let.
Okay. Are you still on there?
I'm here. Go ahead, Efrem.
Okay. Excellent. Okay. So I'm going to the U.S. Well, actually not U.S. I'm going to the crude oil continuous contract June basis on the. Okay. So here it is, and. There's a good reason why I put XOM on. It's kind of interesting. Usually, you go to the commodity markets to get an early indicator of what's going to happen in the stock market. Okay, but it just happens to be that that big cap companies like Exxon that are in the Dow provide actually an early indicator to what's going to happen in the actual futures market, and that's because those are the companies that are engaged in hedging practices and commercial kind of trading in those markets. And if there's indications of topping action and large-scale downside in that equity space tied to the actual commodity market, then that actually gives a heads up that, hey, now you should look at the underlying commodity to see what it says, and that's what we're going to do right now. And looking at that, well, when I zoom in over here, we had a situation where we had the green boundary start curling underneath the pink boundary that says the risk was down to the pink boundary. Okay, well, we already passed that, but we also had a situation where this teal boundary was curled underneath the yellow boundary, okay? And that puts us at risk down to the bottom of the yellow boundary. Now, fortunately, there's a whole bunch of boundaries here that are sloped down for a long time going into the end of the year. So, from the perspective, the downside risk, the tail risk for the crude oil would be about 82.60, okay? Now, do we have to go immediately down to 82.60? No, you don't have to immediately, because you can see over here. Do you see here? Let's talk about the opposite of a sell signal. The opposite would be, instead of curling underneath, you're curling above. Well, here we have the pink boundary starting to curl above the blue boundary. But in the future, you could see the blue boundaries coming down very, very quickly. And you're also capped by a longer-term boundary that's capping price going into the June 20th area. So you've got a heavy cap on price into 101.37, okay, which basically means that even if there's a rally, there's going to be another sell signal, because you could already see there's projections here that are extending down into the 88.20 area. And then once you're there, you're just, you're in no man's land between two boundary conditions where there's really no floor of support. And even if you did get a rally back up, again, you're still bounded. So most likely, this is your tail risk. And XOM is certainly indicating, that kind of potential. So now the highest, technically, is ultimately what is the upside risk? Well, if the Federal Reserve would have managed to stave off this sell-off, and these areas didn't break, but it's already too late, they broke, then if prices in oil would have got above, unfortunately they didn't. If they would have got above 117, yeah, you could have had a real crisis, because going to the longer term chart here, you know, and the China story isn't over. It just happens to be that it goes through boom and bust every few years. Ultimately, they will recover, but in the meantime, there'll be a lot of pain in the rest of the world. So you can see over here, it's a real problem with oil on a weekly basis. You can see the white boundary has curled on a weekly basis all the way into October, okay, and actually precisely into September the 21st. And actually, September the 23rd to the 24th happens to be a very important Gann date. W.D. Gann was a trader that amassed over $50 million in his day back in the early 1900s. Was right on about 94% of the trades in real time. And since then, nobody's been able to figure out what the heck he did, because pretty much everything got destroyed, all his most important calibrations and all that. And I'm aware of Gann and those dates, but the point is that you could go to just as many Gann dates that don't work. So there's obviously additional details that Gann used, and every trader that uses whatever system, you know, better understand their own nuances around what they're doing. It just happens to be in this case, you know, the market perceptions happen to inflect into the Gann date, which happens to be September the 23rd to 24th of this year, and Gann dates usually mark an extreme that caps the market in that situation. And in this situation, basically the market is under pressure, meaning we're going to come down to the bottom of this purple boundary, which is at, you know, the low 80s area, which is still fine technically for a lot of the oil producers, especially, you know, the ones that need prices above 80, because if they're below that, then it's hard for them to actually do well at all. So that's the key thing there. But, you know, based on what Exxon is showing us on the chart, longer term, maybe this is the short-term bounce over here, and especially you can see longer-term boundaries are completely sloped down here. So even if we penetrate that level on a capitulation in the equity markets, you still have, you know, major support going through, you know, April of next year into the 71 area down to an extreme of $60.08. So yes, that's a huge downside risk. But at the end of the day, what that actually carves out, like assuming we don't go, you know, all the way down to this area, because this next area is like 45, that would be about the extreme. That would be like an 87 style kind of capitulation, and then you would likely reverse and find resistance, you know, at 86. So the 80 to 86 areas would probably be the general equilibrium after a large-scale retracement in the event of something more ominous than the low 80s. But you could see longer term here, these boundaries start flattening out. So as long as price doesn't go spike below here for too long and just kind of level out in that, you know, even if they level out in the 70 to 80 area for an extended period, whether it's even into 2014, and then they break above the area where all these start sloping down, and that area would be like about 114. Then yes, at that point, initial resistance would be around 130, but beyond that, there's a nice clean gap up to 160. And then, of course, you know, this is the number where, you know, everybody who's talking about $10,000 for gold, well, if you got oil above 167, yeah, it's probably going to 300. But the reality is, one piece at a time. No point going out to 2014 when in the near term there's actually a clear signal that says that there's plenty of risk both in the equity market in the energy sector of equities and also in crude oil, and any retracements will be met with additional selling. Even if the market got back to 107 again after a capitulation down in the S&P, as far as I'm concerned, it's an automatic sell. Or at least you should be looking at your indicators, and what I would think is that almost any trading strategy would tend to, at that point, notice that the equity curve is responding more to shorting the market at those extremes than to buy the market. And that is basically the outlook of crude. There's only one last thing I just want to mention to complete everything over here. And I just want to go quickly back to U.S. Treasuries to a shorter term chart, because somebody was short the Treasuries, and I'm not sure exactly if their mentality was being short for a very short-term trade or a trade that would put them at potential risk. Because as a short-term trade, yes, there's setups that are developing, but pretty much, like over here, the next setup that's developing, if I look at this over here, if I zoom in, I could see this red boundary is starting to slope up over here. But it's sloping up into the point where the white boundary is still sloped down. So we would need to get some kind of, we're limited to a retracement here. Then the next time we get a rally back up, if this purple boundary rises up above the teal boundary, okay, yeah, then at that point you could come down to the bottom of the teal. But you can see the teal boundary is rising rapidly. So really, you've got a floor over here at about 147 in 8/30 seconds, okay? So based on that floor over there, it's likely that this is a key level, and basically in the short term you're bounded at that 149, 152 area, and there's a lot of trading opportunity to go back and forth. But the big term picture was that other level that I gave on the daily basis. So that concludes the presentation. I assume there are no more questions at this point.
Thanks, Efrem. That'll wrap it up for the day. I would encourage everyone to sign up for the Twitter leads, and also stay in tune with the website. And there will be more video briefings coming on a weekly basis. Thanks for being with us today.
Thank you all.